If the scariest ticking in the world isn't a bomb, but a spreadsheet, what wire do you cut? No red wire, no blue wire, just rows of promises that only work if tomorrow stays cheap. Every time interest rates jump, the timer speeds up. You don't hear it until it rattles your mortgage, your job, your pension. In the next few minutes, you'll know where your country's fuse is and what actually diffuses it. Let's open the device. It has 3 parts. The timer, the rollover calendar when debts come due and must be refinanced. The fuse, the interest rate, the higher it goes, the shorter your time. The charge, the mismatched short-term funding for long-term stuff. Foreign currency bets without matching income, and safe collateral that only works when markets are calm. Here's why the ticking got louder. We spent a decade after 2008 in a world of near zero rates. Borrowing felt painless. Everyone got used to rolling debt forward. Then the 2020s hit. Pandemic, supply shocks, war, and the fastest rate hikes in modern memory. The debt didn't appear overnight. The cost of carrying it did. Keep 3 things in your head. Global debt is north of $315 trillion. One bill matters a lot. Government interest costs huge and rising. One equation decides survival. R versus G. If the interest rate you pay, R, stays below your economy's growth, G, the math behaves. If R is greater than G, the math turns mean. What does a pop actually look like? 3 fast scenes. Greece, 2010. A revised deficit number and the word unsustainable. Lenders want more interest or shorter maturities, or they walk. Yields spike. Bailouts arrive with austerity. The fuse wasn't size, it was trust. UK, 2022. A fiscal plan lands badly. Gilt yields jump. Pension funds using low-risk strategies get hit with high-speed margin calls. By lunch, the Bank of England is buying bonds to stop a doom loop even while fighting inflation. The fuse wasn't ideology. It was plumbing. Sri Lanka, 2022. Tourism collapses. Fuel imports bleed dollars. Reserves run dry. No dollars means no debt service. Long lines for basics. Government falls. The fuse wasn't exotic finance. It was foreign currency. Where does this hit you? Households. In many countries, mortgages reset every few years. A quiet letter arrives. Your payment just jumped. That's the fuse at your kitchen table. Businesses. Cheap loans from 2020 meet 2024 refinancing. We'll roll it becomes at what rate? Projects pause. Hiring slows. Governance. A finance minister stares at 4 columns. Interest, schools, hospitals, bridges. 1 column grows by itself. 3 don't. And the hidden bit. The shadow system breaks first. A strategy that worked at 1% suddenly needs more collateral at 5%. A fund sells what it can, not what it wants. Prices gap. Liquidity vanishes. The timer didn't end. The room just got darker. So how do you defuse a debt bomb without blowing up the room? 5 tools. None are free. Smart countries mix them. Grow out of it. Raise productivity. Nominal growth lifts tax revenue and shrinks the debt ratio if interest costs don't outpace it. Boring policy skills, energy build-outs. Faster permits pays the bills. Gently inflate it away. If inflation runs a bit hotter than interest for a while, debt melts in real terms. Savers grumble. Budgets breathe. The art is a little, not a lot. High inflation breaks trust. Low positive inflation keeps gears moving. Austerity used carefully. Spending cuts and tax hikes can stabilize debt. Too fast in a weak economy, and you shrink growth, making the ratio worse. Credible plans over years beat heroic pain in months. Restructure honestly. When the numbers don't add up, somebody takes a haircut. Faster, predictable restructurings beat endless denial. Orderly honesty is kinder than chaotic truth. Use the valves. Devalue to regain competitiveness. Use temporary capital measures to slow a run. Sell assets or raise one-off revenues to buy time. Valves aren't cures. They're space. What does diffuse look like in practice? Watch the 3 parts of the device. Slow the timer. Extend maturities before stress hits. Lock in rates when you can. Lengthen the fuse. Lower funding costs with credibility. Don't spring surprises. Keep R is less than or equal to G. Move the charge. Reduce mismatches, more fixed rates, less dollar debt for those without dollar income. Make the safe collateral actually safe. Here's the twist almost nobody tells you. Debt isn't evil. It's a tool. Bridges, labs, power grids, good debt outlasts itself. The bomb is not debt. It's bad structure plus bad timing. The moment you rely on, "We'll refinance tomorrow" forever, you've tied your promise to a mood swing. How to read the timer from home without a PhD. Check the rollover calendar. How much matures in the next 12 to 24 months? Watch the interest bill. Is it eating a bigger slice of the budget each quarter? Ask who holds the debt, locals with patience or foreigners with fast feet. Spot the currency mismatch. Debt's in dollars, income not. Debt breaks fast, it fixes slow, but it's not fate. It's design. Slow the timer. Lengthen the fuse. Move the charge. Then do the boring work that keeps trust alive. If this helped you hear the tick behind the headlines, subscribe.